The stimulus trap mechanism. How rate cuts, designed to stimulate growth, systematically suppress the economy's ability to self-correct, inflate asset bubbles that mask structural weakness, and ultimately accelerate the very recession they were meant to prevent. The deeper paradox, the cure becomes the disease. Let me take you back to September 18, 2024. The Federal Reserve, the most powerful financial institution on the planet, cut interest rates by 50 basis points. Not a modest quarter-point trim, a half-point slash. The first rate cut in over 4 years. Markets erupted. CNBC anchors smiled. Your LinkedIn feed filled with posts about a soft landing. And here's what almost nobody said out loud. That cut may have just lit the fuse on the next recession. You heard that correctly. And before you dismiss this as contrarianism or doom-mongering, stay with me. Because the data, the history, and the mechanics of how central banking actually works all point to the same uncomfortable conclusion. Here is the paradox at the center of everything we're going to discuss today. The Federal Reserve cuts rates to stimulate a slowing economy. But the act of cutting rates is itself one of the most reliable recession signals in modern financial history. Think about that for a moment. The medicine and the symptom look identical from the outside. Since 1980, every single major Fed rate cutting cycle has either coincided with or immediately preceded a recession. Every single one. The cuts that preceded the dot-com collapse in 2001, the cuts before the housing market implosion in 2007, the emergency cuts in 2020. Each time, the Fed was reacting to deterioration already embedded in the system. Deterioration that rate cuts cannot actually fix, only temporarily paper over. What if the tool the world trusts most to prevent economic collapse is actually one of the most consistent predictors of it? That is not a rhetorical question. That is the analytical lens through which we are going to examine everything today. Because if you understand this mechanism, you will make profoundly different decisions about your portfolio, your cash, and your financial future over the next 18 to 24 months. We are going to cover exactly how rate cuts inflate dangerous asset bubbles, why this cycle is structurally different and more fragile than anything since 2008, what the real economic cost looks like when this unravels, and most importantly, what you can do right now to position yourself on the right side of this. Understand why rate cuts can fuel recessions rather than prevent them. You need to understand 3 interlocking financial mechanisms that the mainstream financial press almost never explains together. The yield curve, the market's recession detector. The yield curve is simply a graph of interest rates across different maturity lengths of U.S. Treasury bonds. Under normal conditions, longer-term bonds pay higher yields than short-term bonds. That makes intuitive sense. You want more compensation for locking up your money longer. But when the Fed raises rates aggressively, as it did from March 2022 through mid-2023, taking the federal funds rate from near zero to over 5%, something dangerous happens. Short-term rates rise faster than long-term rates. The curve inverts. The 2-year Treasury yield climbs above the 10-year yield. This is not just a technical curiosity. An inverted yield curve has preceded every U.S. recession since the 1960s, with a lag of roughly 12 to 24 months. The curve inverted sharply in 2022 and remained inverted for the longest sustained period in recorded history, over 700 days. When the Fed then cuts rates, the curve begins to uninvert. And here's what most investors don't realize. It is the uninversion, not the inversion itself, that historically coincides with the recession arriving. You see, when the Fed cuts, it's essentially acknowledging that the tightening worked, perhaps too well. The damage is already done. The cuts are the signal that the reckoning has begun. The credit impulse and the debt maturity wall. The second mechanism is what economists call the credit impulse, the rate of change in new credit being extended across the economy. When the Fed raised rates to 5.25–5.5%, it didn't immediately crush corporate borrowers because the majority of U.S. Corporate debt had been locked in at historically low fixed rates during 2020 and 2021. But here's the trap. Between 2024 and 2026, approximately $3.5 trillion in U.S. corporate debt is scheduled to mature and require refinancing. That debt was originally issued at rates of 2%, 3%, sometimes less. It now needs to be rolled over into a rate environment that, even after cuts, remains dramatically higher. That is a cash flow shock that no rate cut can fully absorb in time. The cuts are chasing a wall of debt that has already been built. This is what Nassim Taleb would call a hidden tail risk, a fragility that doesn't show up on quarterly earnings until suddenly, catastrophically, it does. The system looks stable until the moment it isn't. The wealth effect illusion and asset price dependency, the third mechanism, is perhaps the most insidious. When the Fed cuts rates, it makes the present value of future earnings mathematically higher, which mechanically inflates equity valuations. Stock markets rise. Homeowners feel wealthier. Consumer confidence ticks up. GDP data looks reasonable for another quarter or two. But this is the wealth effect, a psychological and paper phenomenon, not real productive economic growth. What the Fed has effectively done over the past 15 years is make the entire U.S. economy structurally dependent on asset price inflation to maintain the perception of health. The S&P 500's cyclically adjusted price to earnings ratio, the Shiller KP ratio, was hovering above 34 at the time of the first 2024 cut. To put that in context, the long-run average is approximately 17. The only times this ratio has been higher in history were 1929 and the peak of the dot-com bubble in 2000. Both times, what followed was a severe, multi-year bear market and recession. When you cut rates into that environment, you are not stimulating a healthy economy. You are inflating an already dangerously overvalued market with more cheap money, and making the eventual correction geometrically larger. Now let's talk about what this actually costs in dollar terms, in jobs, in the quiet erosion of financial security that most people never see coming until they're already in the middle of it. The 2008 financial crisis, itself preceded by years of loose monetary policy and the asset bubble it created, wiped out the $11 trillion in household wealth in the United States alone. It eliminated 8.7 million jobs. It took the median American household nearly a decade to recover to pre-crisis net worth levels. And those are the visible costs. The invisible costs are the ones that matter most for our conversation today. Think about what sustained low rates did between 2009 and 2021. They punished savers, absolutely annihilated the concept of a risk-free return. A retiree who followed conventional wisdom, put their life savings in bonds and cash instruments, earned effectively nothing for over a decade. They were forced into equities, into real estate, into risk assets they didn't fully understand, simply to generate any return at all. That is what economists call financial repression, and it was deliberate policy. The goal was to push investors up the risk curve to stimulate growth. The cost was that it transferred risk from institutions to individuals on a massive, largely invisible scale. Ray Dalio, founder of Bridgewater Associates and one of the most sophisticated macro thinkers alive, has described this dynamic with unusual clarity. His framework of the long-term debt cycle, which he argues plays out over 75 to 100 years, suggests that we are now in the late stages of a cycle where debt levels have grown so large that traditional monetary policy tools have lost most of their effectiveness. Rate cuts, he argues, now produce diminishing stimulus while generating increasing systemic fragility. The fear mechanism running through all of this is currency devaluation fear. The slow, grinding realization that each dollar of savings buys less in the future than it does today. From January 2021 to January 2024, cumulative U.S. inflation exceeded 20%. That means a dollar of savings in early 2021 was worth approximately 80 cents in real purchasing power by 2024, a silent 20% wealth tax on every person who held cash. Rate cuts by design risk reigniting that dynamic. When money becomes cheap again, When borrowing costs fall and credit expands, inflationary pressure does not disappear. It merely shifts, migrates, reappears in housing, in food, and services. The Fed is not choosing between inflation and recession. It is choosing which kind of pain to deliver and to whom. And the people least equipped to absorb either outcome are the ones in the middle. Not wealthy enough to hedge, not poor enough to qualify for government assistance. The people watching this video, let's make this real. Let's talk about what this looks like in your life, in your portfolio, and in the decisions you may be making right now based on assumptions that no longer hold. The drawdown you didn't model, if you held a standard 60-40 portfolio, 60% equities, 40% bonds in 2022, here is what happened to your net worth. You lost approximately 16% in a single calendar year. The bonds, which were supposed to cushion the equity drawdown, fell simultaneously. Why? Because rising rates crushed bond prices at the same moment they pressured equity valuations. The historical negative correlation between stocks and bonds, the foundational assumption of modern portfolio theory, broke down entirely. Investors who had anchored their risk models to pre-2022 historical data discovered painfully that their safety net had been sewn from the same thread as the risk they were trying to avoid. Now, in a rate-cutting cycle, the opposite positioning risk emerges. Investors who overweight equities and long-duration bonds in anticipation of a rate-cut rally may find themselves dangerously exposed when the reason for those cuts, deteriorating economic fundamentals, eventually asserts itself through earnings misses, credit defaults, and rising unemployment, career and income. The lag effect nobody talks about. Here's a scenario most financial commentary ignores. The job market does not deteriorate on the day the Fed cuts rates. It deteriorates 9 to 18 months after the tightening cycle does its damage. We saw hiring freezes begin quietly across technology, finance, and real estate sectors throughout 2023 and 2024. Layoffs in interest rate-sensitive industries, mortgage origination, commercial real estate development, leverage finance were already underway before the first cut landed. If you work in any of these sectors, or in sectors dependent on corporate capital expenditure, rate cuts offer you false comfort. The decisions that will affect your employment were made in the boardroom 12 months ago, based on a cost of capital that made expansion unprofitable. A 50 basis point cut does not reverse a $500 million capital expenditure decision that was quietly shelved in a Q3 earnings call. Savings and wealth, the refinancing trap. Millions of homeowners who purchased property between 2020 and 2022 locked in mortgages at 2.5% to 3.5%. They are effectively frozen, unable to move, unable to downsize, unable to trade up, because doing so would require refinancing into a rate environment that remains punishingly higher, even post-cut. This lock, in effect, has contributed to a trophic collapse in housing inventory and an equally irrational persistence in home prices that has made housing unaffordable for first-time buyers at virtually any income level below six figures in major metropolitan areas. The rate cut does not solve this. It slightly reduces the new mortgage rate on the margin from perhaps 7.5% to 6.8%, but it does nothing for the structural affordability gap that has opened between wages and home prices since 2020. Behavioral finance, the rally that traps. This is perhaps the most dangerous manifestation of all. When the Fed cuts rates, markets typically rally, at least initially. That rally activates FOMO, fear of missing out, at precisely the moment when caution would be strategically warranted. Retail investors, watching indices climb on the news of easy money, rotate into risk assets at the exact point when institutional investors, who have access to better data on credit conditions, earnings forecasts, and forward-looking indicators, are quietly rotating out. This is not speculation. The data on retail investor flows versus institutional flows around prior rate cutting cycles shows this pattern repeatedly. The retail investor becomes the exit liquidity for the smart money. There is the counterparty risk embedded in the commercial real estate market, a sector that has been quietly imploding under the weight of remote work adoption and rate-driven cap rate expansion. Commercial real estate values fell an estimated 20-25% from peak to trough between 2022 and 2024. Regional and community banks, which hold a disproportionate share of CRE loan exposure relative to their capital bases, are sitting on unrealized losses that have not yet been fully marked to market. This is the off-balance sheet fragility that almost nobody in mainstream financial media is pricing into their recession models. Rate cuts help at the margin, but they do not instantly restore the value of a half-empty office tower in downtown San Francisco or Chicago. The unlearning process begins when you stop asking, "Is the market going up?" and start asking, "What is the market not telling me?" So what do you actually do with all of this? Because information without action is just expensive anxiety, and the goal here has never been to frighten you. It has been to equip you. Here are 4 specific, actionable strategic frameworks for navigating this environment. Rebalance toward genuine uncorrelation. The 2022 breakdown of the stock-bond correlation was a warning. In a stagflationary or credit stress environment, traditional diversification fails. Consider genuinely uncorrelated assets, commodities, particularly energy and agricultural commodities, which tend to perform well when inflation accelerates. Gold and gold mining equities, which historically outperform during periods of real negative interest rates, and infrastructure assets, which generate inflation-linked cash flows independent of equity market sentiment. This is not about abandoning equities. It is about ensuring that your portfolio contains assets that do not all fall together in the same stress scenario. Volatility hedging, options, inverse ETFs, and tail protection for investors with the sophistication and risk tolerance, purchasing put options on broad indices, or allocating a small portion of the portfolio to inverse ETFs can provide meaningful downside protection during a disorderly market decline. The cost of this insurance, measured as a percentage of portfolio value, is almost always lower when volatility is compressed, which tends to be the case in the early stages of a rate-cutting rally. Think of it this way: you do not buy fire insurance while your house is burning. You buy it before. Divide your financial assets into 3 distinct buckets based on time horizon and function. Bucket 1, 6-12 months of living expenses in high-yield cash or short-term treasury instruments. Your operational liquidity, never touch for investment purposes. Bucket 2, 3-7-year intermediate assets, a mix of short-duration bonds, dividend-paying equities, and real assets designed to generate income and moderate growth without catastrophic drawdown risk. Long-duration growth assets, equities, real estate, higher risk instruments, with a genuine investment horizon of 7+ years, allowing you to survive a prolonged bear market without being forced to sell at the worst possible moment. The single most destructive financial behavior in a recession is being forced to sell long-term assets to fund short-term needs. The 3-bucket strategy eliminates that possibility. Stress test your portfolio against historical scenarios, pull up your current portfolio allocation, and run it through 3 historical scenarios. Collapse, S&P 500 down 49%. The 2007-2009 financial crisis, S&P 500 down 57%. Shock, S&P 500 down 25%, bonds down 15% simultaneously. If your portfolio cannot survive the worst of those scenarios without forcing you into behavioral errors, it is not yet properly positioned for what the current macro environment may deliver. This is not pessimism. This is stress testing, the same exercise that regulators require of systemically important banks and that you should require of yourself. I want to leave you with a thought from someone who has navigated more market cycles than most of us will ever see. Warren Buffett has said that the investor's chief problem and their worst enemy is likely to be themselves. Not the Fed, not the market, not the economy, themselves. What he means is that the financial system is not designed to destroy your wealth, but your reactions to it, the fear, the FOMO, the herd behavior, the paralysis, those can accomplish that just as efficiently as any market crash. The Federal Reserve cutting rates is not the end of the world. It is a data point, a significant, historically meaningful data point that tells you the system is under more stress than the headlines are admitting. It tells you that the people in charge of monetary policy have concluded that the risks of inaction now outweigh the risks of intervention. That is valuable information. It is not a reason to panic. It is a reason to prepare. And that distinction between panic and preparation is the entire difference between the investor who survives the next cycle and the one who doesn't. If this breakdown gave you something you haven't heard anywhere else, a framework, a mechanism, a way of thinking about what's actually happening beneath the surface of the financial news, then do one thing: hit subscribe. Because this channel exists for exactly one purpose: to give you the analytical depth that the mainstream financial media consistently fails to provide. Every week, we go deeper. Every week, we follow the data where it actually leads, not where it's comfortable, not where it's popular, but where it's true. That's the only kind of financial education worth your time.